Between the summers of 2006 and 2012, the United States experienced its largest housing crash since the Great Depression. It wasn't just a crash, it was a catastrophe that shook the foundations of the global economy. The collapse of the U.S. housing market sent shockwaves far beyond America's borders, triggering a recession that touched every corner of the world. Banks failed, jobs were lost, savings disappeared, and the world learned a harsh lesson about the dangers of unchecked speculation and greed. But here's something most people don't realize. While the headlines, documentaries, and movies obsessively covered the 2008 financial crisis itself, almost no one talked about what led up to the crash. That slow, steady growth of the bubble, the years when housing prices seemed to climb endlessly, were filled with signs that something was deeply wrong. People just didn't pay attention. Or maybe they didn't want to see the truth. After 2002, real estate in America became what you could rightly call a modern-day gold rush. Prices were going up so fast it was almost surreal. Every day, buyers were seeing prices rise, sometimes even before they had closed on a home. And yet, many of those buyers were unhappy and unsatisfied. They felt trapped in a market that was spiraling out of control, with no clear end in sight. Imagine this. You're looking for a home, but each time you think you found one, the price has jumped higher than you expected. You feel frustrated and worried that you might miss out, so you jump in anyway. Sound familiar? This is exactly what millions of Americans experienced. And if it sounds a lot like what we're seeing in the housing market today, you're not alone. Many experts agree that history is, in many ways, repeating itself. Since the crash bottomed out in 2012, home prices have been steadily climbing again. Then came 2020, a year no one could forget, when a global event shook the world and, paradoxically, sent real estate prices soaring to new heights. The market exploded with demand, low interest rates, and an influx of speculative investors looking to cash in. This brings us to the present, where the question on many people's minds is, what's happening in the commercial real estate market? Is another crash looming? Tom Seymour recently asked a great question, quoting Charlie Munger, Warren Buffett's longtime business partner. Munger warned of a brewing storm in the U.S. commercial property market, where American banks are sitting on what he called bad loans as property prices begin to fall. He asked, how bad will the losses be, and which sectors or locations are likely to be hit hardest? Charlie Munger didn't sugarcoat the situation. He predicted that the hollowing out of downtown areas in the U.S. and elsewhere will be quite significant and unpleasant. He believes the country will survive, but it will often mean a new set of owners taking over these properties. The buildings themselves don't disappear, but the owners do. That's a reality many investors know all too well. So, what does this all mean? Simply put, the current real estate market isn't normal. It's a bubble, and not a healthy one. Looking back at the early 2000s, we see striking similarities. The signs of excessive speculation, risky loans, and greed were all there. Today, many analysts believe we're in the final, most dangerous stage of the bubble. A time when prices are driven more by hype and gambling than by real, sustainable value. This is tragic because there are so many better, more honest ways to make money. Ways that don't involve riding the roller coaster of real estate speculation. For example, there's a secret business model I recently discovered that almost no one knows about. It's a more reliable and profitable way to earn an honest income without falling into the trap of the housing bubble. If you're curious, check out the link in the description to learn more. Before the 2008 crash, the media was full of stories warning about a looming disaster in the housing market. But Hollywood chose to focus on the drama of one man's story, the famous narrative of someone who saw it coming. That story became the basis for a hugely successful movie, capturing the public's imagination. But the truth is more complicated. Many big investors and everyday enthusiasts knew the bubble was growing. The difference? Most didn't walk away with nine-figure paydays. One of the smartest people to speak out before the crash was Warren Buffett himself. At the 2006 Berkshire Hathaway annual meeting, just 2 years before the market collapsed. Warren was asked about whether residential real estate was in a bubble. His answer offers an eerily clear warning that sounds almost exactly like what's happening today. Warren explained that speculative real estate investors were using high leverage, borrowing lots of money to buy properties in the hope that prices would keep rising. Combine that with greed, and you have a fatal mix that would lead to a market implosion. He pointed to cities like New York, where property values swing dramatically over time. He noted that the slowdown was visible everywhere, especially in the hottest markets, the high-end ones where people were buying homes more for investment or speculation than to live in. What Warren made crystal clear was this: when people buy homes to live in and have steady jobs, they tend to hold on to their houses, even if the market dips. Sure, the value might drop below what they owe on their mortgage, but they don't move out. This stabilizes the market to some degree. But when the market is flooded with investors who treat homes like stocks, buying and selling on a whim, chasing quick profits, the market becomes unstable. Prices can swing wildly because these day traders in real estate are quick to panic and sell when they see signs of trouble. Warren's insight was powerful. Investors have turned the real estate market into a gambling game. They treat houses worth hundreds of thousands of dollars as if they were cheap stocks to be flipped in minutes. If you look at the data from the years leading up to the crash, you'll see investment activity in real estate shot to record levels. Many deals were backed by risky, sometimes fraudulent loans. Buffett also explained why real estate prices are so volatile. Unlike stocks, which trade every minute on open markets and provide constant price updates, homes only sell occasionally. Their values are often estimated based on just a few sales of similar properties nearby. So you might think your home is worth a certain price because a similar house down the street sold for that amount a few months ago. But this method is unreliable and prone to wild swings. A few bad sales can quickly cause the entire neighborhood's prices to tumble. He pointed out that it only takes one buyer to keep a neighborhood's prices artificially high. But when word spreads that prices are falling, panic spreads, and everyone rushes to sell. That's when the market crashes hard and fast. This pattern played out dramatically in Las Vegas during the 2008 crisis. For months in 2007, the city saw property values drop by more than 5% each month. Imagine a house worth $250,000 losing $12,500 in just 30 days. It only got worse. From April 2008 to April 2009, average home prices in Las Vegas plummeted by 40%. In some neighborhoods, losses reached a staggering 65% within a single year. For many investors who bought near the peak, this was financial ruin. The once booming market turned into a nightmare of lost equity and foreclosures. As the saying goes, when a bubble bursts, it's not just a pop, it's an explosion. Warren Buffett and Charlie Munger have spoken about this repeatedly. At Berkshire Hathaway conferences, they've warned that reckless lending and speculation almost always lead to disaster. Charlie Munger explained that some of the bad lending practices that caused trouble in manufactured housing finance had now moved into traditional home loans. He said, "There is a lot of ridiculous credit being extended in the housing field." He pointed out that dumb lending always has consequences, but those consequences take time to show up. It's like a disease that spreads slowly before becoming obvious. This isn't new. Back in the 1980s, the U.S. had similar problems in commercial real estate lending, leading to a crisis that caused many banks to fail. Munger's message is simple. Developers will build anything if they can borrow money to do it. And when banks recklessly pour money into projects, you end up with too much construction, empty buildings, and eventually a crash. Today's bubble looks disturbingly like the one from the early 2000s. It's not exactly the same, but the patterns rhyme. Bad loans, speculation, and wild swings in prices. And just like before, this roller coaster is bound to end in a jolt. In an earlier video, I shared Warren Buffett's honest thoughts on gold as an investment. That video sparked a lot of anger, with some viewers accusing Buffett of being wrong or even misleading people on purpose, possibly in cahoots with the Federal Reserve. If you want to understand that story better, watch the video linked on your screen now. But for now, here's the bottom line. The housing market is complicated. It's driven by emotions, speculation, and sometimes outright greed. The crashes of the past remind us that bubbles don't just deflate slowly. They burst violently, dragging down many innocent people along with the reckless investors. Smart investors watch the signs. They know when to hold on and when to get out. They look for ways to build wealth that don't depend on the fragile hope of ever-rising house prices. So what do you think? Are we heading into another crash? Or will this time be different? Drop your thoughts in the comments below. And if you want to learn more about that secret investment strategy I mentioned, the one almost no one knows about, check the link in the description. Because history teaches us one thing for sure. The biggest opportunities often hide right where the risks seem the highest. Thanks for watching. I'll see you in the next video.